Hey guys, it's the Hubs. So Maria and I had a really good time talking to you guys about finances and what we're doing. But as you guys saw in that video, it was kind of long. Got a lot of responses from it because there's so much to cover. And I've got some notes. If you see me looking down at, that's what that is. But I'd like to dig in a little bit deeper, per your request, into kind of the spreadsheet that I was talking about and this tool that that I use in our household. It's a growing, evolving document to help me track a few things. So a couple disclaimers first. The purpose of the spreadsheet is really to look at your income, your expenses, and to really understand where your cash flow is at as well. I'll talk a little bit about investments and also debt reduction too. But remember, the core thing about all the tabs that we'll look at will be income, expenses, and really building up to what your cash flow is. You should use it to project, you should use it to plan, and most importantly, you should use it to dream as well. Don't forget that. Use it to dream. Use it to figure out what you're trying to accomplish in your life. I want to be debt-free by the time I'm 50. I've got about 16 years to do that. That's part of our dream, but it takes a plan to get there as well. So I really hope to give you a great start, a great foundation. If you do have questions, make sure you post or you ask in this video. Happy to explain in the comments or in more detail. So please do share this as well. So let's dig in. The software that you're going to use. So if you have a Microsoft computer and you have access to Excel, that's Microsoft Excel. Apple has their own spreadsheet software as well. Some folks that have Apple computers, you can get Microsoft Office on your computer. However, if you do not have a computer or you don't have an app, or you don't have a way to get a Microsoft product, which is basically what I'm going to be talking to, Google has their own free software, and I can't remember the name of it. It may be Google Spreadsheet if I'm correct. I think the Word version of Google is like Google Docs. So Google Spreadsheet, if I'm correct, is a free open source software that will allow you to do all the things that we're going to talk about today. So there will be some discussion of formulas, some discussion of tabs. I'll really try to make sure to explain that. So again, software you're going to use if you're a Microsoft user or if you have Microsoft Word on your Apple computer. This is Excel. If you're going with the open source version, this would be Google Spreadsheet. I do encourage you to use a computer on this and not a tablet or not a phone. It can be done, but building this and manipulating it in a tablet, I've never done that before. Again, it probably can be done, but I really wouldn't recommend it just from an ease in use, and could be a little frustrating as well. So the first few tabs I'm going to talk about are not really for tracking your cash flow, not really for tracking your your income or your expenses. They're really just some general things that I think you guys should have in your system. So first off is all of your account and login and credentials and all of your passwords. So when you open up a spreadsheet, typically what you have is on the bottom, you have tabs, okay, like tab 1, 2, 3, and you can add almost as many tabs as you like. Okay, in your first tab, which should be the spreadsheet that you're in right now, everything from AT&T to Verizon to Netflix and you can categorize them. Usually I categorize them as like bank, credit cards, student loan or loans. You can have entertainment. I have social media in there as well. This is something that Maria and I are talking about updating probably on a semi-annual basis. If one of us were to pass away, we would need to have access to that, to our spouse, to Maria would need to have access to mine, excuse me, a little tongue-tied, and I would need to have access to her information to make sure that any bills need to be paid, and especially if you're in a situation like me and I manage the finances for that family. So Maria knows that lights come on when she flicks the switch, or the gas is on when she needs hot water, phone's still on. However, it's not really in the weeds and in the details on when stuff is paid and what login info is and what's automatically withdrawn. So I really encourage, it's very, very simple. Take the time to get everything that you do that's online that has a password and put it in this tab. If you're like me as well, sometimes you forget your passwords because they make you update and they make you change them, and you just forget. And it's nice to have a place on a secure spot in your computer, on your computer, that is protected or is encrypted, where hackers can't get to, where you can get this. So that's tab 1. That should be very, very simple. to think about, but it's a little bit more difficult when it comes time to all the information. Another thing that you want to do is on some of your accounts, you're going to have extra login questions or credentials. Like when I log into our Regions account, it asks me a question about my family. So, and there's usually 3 questions that they kind of rotate through. Some of the other credit card accounts or loan accounts do the same thing. If you have an image that's associated or you have other questions, you want to load those in there as well. Again, that takes a little bit of time to do, but if something were to happen to you or if you were to forget, you want to make sure that that information is there. Okay, so I beat that horse. That's a dead horse there. The second is this is the second tab. So you've created that first tab, all right? The second tab you want to go into to create a whole new blank spreadsheet is a summary of all credits, loans, bills, anything that is a payment that you're making on a monthly basis, all right? So this information is going to kind of feed into a couple of the tabs that are coming in later. So usually what I do is this, you don't have to order this in any type of way because there's some tools that you can use, a sort function in Excel or in Google Docs and Google Spreadsheet that will allow you to range it from greatest to least. All right. So what I normally do is say I have a Chase credit card and a Capital One credit card and whatever else that you have, and then your student loans or your auto bill. I'll list those. So the name of the bill in this first column. So name of bill and then all of your bills. And then on the next one I'll do the amount, the average amount typically that I pay per month. Okay, so usually what I do there is like the minimum, okay, so just whatever I owe the credit card company or my loan. And I list that. So for my credit card 1 or my loan 1, I list my amount that I need to pay. Okay. The other things that I'll list as well is I'll list the amount of the loan. Okay. So, my car loan is for XYZ amount. All right. And I owe a amount. So my car loan is for $25,000, but I owe 15. All right. The same thing for your credit card as well. So here's how much credit I have, and then here's how much I owe. Really what this gives you is it gives you the ability, especially on your credit, not so much on your loans, all right, but on your credit cards, it gives you the ability to understand your balance, how much you have left, all right. Now, this isn't something that I look at on a monthly basis. It's usually something I look at on a quarterly basis. So as we're knocking down debt, or in the instance that debt increases because we're using that to do something for our home, or we've just come off of a vacation, or we've bought a car or a house note, just bought a house, so that'll be on there as well. It just gives me an understanding on a very macro view what I have that I need to be focusing on to, as we'll talk about later, knock down from a debt standpoint. It also helps me understand if I take all of the summation and give me a sum of how much total debt do I have. And that's a good number to have. I think you should know that number because as you think about decisions you're going to make, tax season is here. If you get a tax return, yes, that new camera or that new car or that new purse or that new insert, whatever, there's always stuff that we're going to want. New pair of shoes, new gaming system. You need to really think about that in the backdrop of your current financial situation. So it's good to know how much total debt you have. And you can break it up mentally in your mind as good debt or bad debt. Some folks would say credit cards are bad debt, okay? Maybe that's another series that we can talk about, or small talk we can talk about. But student loans is usually considered good debt. House notes is usually considered good debt, okay? So you can break it down in your mind like that, but how you organize it, I just usually go from my monthly payment, not from the amount of credit that I have or how much I owe, but what's my largest monthly payment? I sort by that, and then all the other fields will organize themselves. Okay, and then the other thing that I would do there as well is just update your APR term. So if your credit card is at a 15.9% interest or higher than that, update that. A lot of times what that does for me is it forces me to make sure to go in and remember those, and I can call the credit card company as I'm making adjustments in my debt. As you lower your debt, you want to be calling to ask for a rate decrease. All right, that's something that you should do, especially if you have a variable rate. So that's the second tab, all right, which is really just a summary tab of all of your credits, your loans that you have. This is not where you put your phone, your Verizon or your Sprint bill. This is not where you put your electrical or your gas bill. We'll talk about that later. So the third tab is really the kind of the meat and potatoes tab, which is the notions about the tracker and whatnot. So this is really your monthly tracker, and the purpose of this is to understand on an average month, and every month is a little bit different, okay? It's hard to average out what, Maria and I are learning this. In a new house, what's your gas bill gonna be in November or December versus what it's gonna be in April or May, okay? Or your electric bill. Now, a lot of your stuff, like your phone bill, your cable, if you have Netflix, other stuff, is gonna be a set amount. All right, so I wanna start kind of at the top, all right? Because this is really basically, I call it a tracker, but it's almost a pro forma, okay, which is an imprecise document used for forecasting and projecting kind of in the financial world. Accountants should know that. It's a pro forma or a snapshot of an income statement for you. So it's not an actual live income statement for your house, but it's a projected income statement, all right? And there's some variables that you can manipulate to help you plan and project, which we'll talk about that first. But follow along with me, let's get the foundation set first. So first thing you wanna do is income, all right? And again, what we're doing is income minus expenses, and that's gonna give you what your net profit is or what your net loss is potentially per month. Hopefully you guys don't have a net loss. You wanna build this to be able to see and observe that. So for your income, what I would recommend is this. First off, you wanna understand, what are you expecting to be paid in a calendar year, all right? So for me, I have a specific salary. That salary is, let's just say that salary is $50,000, okay? Just use an example situation. So I make $50,000 per year, all right? And I expect a 10% bonus, okay? So totally, I make $55,000 a year, all right? So you wanna capture that. Usually what I do is I capture that as BO income. All right, and I'll put in my next column, which I do this as a rolling 3 years. So I'll do 2015, 2016, 2017. So in 2015, my salary is $50,000 as an example. Okay, then I'll put bonus. My bonus is $5,000 because I'm expecting a 10% increase. All right. And then under that, what I also have is Maria and I largely operate our household off of one income, okay, which we usually operate that off of mine, but it takes her to really balance the equation in our household. So I also have, and you can have this as well, for whomever is in your household that is contributing to your income, okay, this is total household income. If you're single, it's you. If you're living with somebody and you're counting all of the income sources, it's 2 people. If you've got 3 people that are contributing because you have a brother or a sibling that lives in, you can adjust that. But I would have Maria salary or income. Even though she's not salaried and it's variable, we make some assumptions, okay? Right now, Maria doesn't get a bonus per se, so I just capture that all within her tab there, all right? And then what I would do is divide that all by 12. Okay, and that gives me an average for the month, all right? Now from a bonus standpoint, usually most companies pay bonus annually. Some folks get a bonus at the end of the year. I don't base my monthly budget including a bonus at all. I base it purely off of salary, purely off of what I should expect to receive. A bonus is just that, it's just a bonus. But sometimes in the back of your mind, it's good to know that in May I'm gonna get this, or in September I'm gonna get that. And that can help you adjust. That's the human element of having to make a plan. You can adjust for that. For some people as well, you get money back for taxes. I wouldn't encourage you to put taxes in that bonus space. I would just treat that completely separate. So, you've got income for me, income for Maria, okay? And then you've got that all summed together, and that's gonna give you a monthly view of what your income is. So remember, that's your annual income. So me plus Maria together. So let's say that is $75,000. I divide that by 12, okay? And that's my before tax income that I have. Now, what I would encourage you all to do is understand what percentage of your paycheck you take home. So roughly, we live in a state that does not have state income tax. I know roughly the way that I have my paycheck worked out. I take about 77.5% of my paycheck home. Now, what that factors in is 401k, that factors in FICA, that factors in Social Security, it factors in the government taxes, all of that. So really what you want to do to get that number, and why this number is important, is because that's the number you're going to be operating off of. What cash do you have available to work with? Take that number, this is how you're going to get it. Go to your paycheck and you see what you get paid, all right? So that's in your numerator. Ooh, I have to remember my fractions, okay? That's on top, and you divide that by what's on the bottom, which is your salary divided by whatever pay period you're in. So I get paid 52 times a year. We get paid weekly. Some folks get paid monthly or bi-monthly or bi-weekly. And for those of you that don't know bi-weekly versus every other week, if you get paid every other week, you get 26 paychecks. If you get paid if you get paid 2 times a month, you get 24 paychecks. Okay, so just remember that. So again, what you're going to do is take, when your paycheck says if you make, let's say again you make $50,000, and let's say your paycheck is $975. Okay, well, and let's say that bottom is $1,200. I'm making up numbers here. 975 divided by 1,200 is going to give you a certain percentage. Okay, and in that way, what you can know is that's kind of, you can annualize that to give you what your monthly income is. Do the same thing for your partner or whomever else is in your household, and that's going to give you your after-tax amount that you're going to be operating with per month. Okay, so after you've done that, all right, what you're going to do is list all of your expenses. Okay, now some of that information you've captured on the second tab. All right, you've captured your loans, you've captured your credit cards. Take all that information and just copy it back into this. What you're also going to want to add is you're going to want to add your mortgage or your rent. If that's not captured there, you're going to want to add your utilities, any Netflix, Amazon, pet insurance, anything, life insurance, anything that you have that is not captured between your credit cards and your loans, but you pay on a monthly basis. Okay, or you pay on a quarterly basis. Like our trash bill is due on a quarterly basis. All right, so what I do for that is, even though I pay it every 3 months, I accrue for it or account for it every month. I just divide it. It's $51 per every 3 months. I just do 51 divided by 3. That's 17. So my monthly amount for that bill is $17, even though I'm not paying $17 a month at any one given time. So after you've done all that, okay, so you're gonna have under those rows that have like Bo income, Bo bonus, Maria bonus, and you have total, all right, and you have your total income per month. Then you're gonna have your bills, all of your bills listed, okay? Remember for 2015, 2016, 2017, okay? And then you just list it out. AT&T, $100, Verizon, $200, water, $100. You list all of that out. At the bottom, what you're going to do is you're going to take a sum of all of your monthly bills, okay? And at the very end, you're going to take the sum of your income minus the sum of your bills, and that's going to spit out what you have as what I would call, what folks would call discretionary income, okay? Which means that's what you have left over. That's your income statement. That's the profit that you have left over after you've paid all of your expenses. Now, in that, there's 2 things you can do, okay? Because what Maria and I are getting ready to do, because like I told you guys, we've kind of come out of this survival mode. So I've used this to understand kind of where we're at and where we're going. But my 401k contribution is captured inside of that percentage that I got to in my income, okay? So like my 77.5% is a percentage of my income that's going to my 401k. But you can drop in that expense piece, like eating out, or miscellaneous, or fund money, or 401k, or IRA. I would encourage you to drop that in your expenses. If you don't want to treat it as an expense, you can do a subcategory of either like savings or savings and entertainment. If you truly want to treat your expenses up here as just like mandatory stuff that you have to spend, but just know that that's really up to your discretion. But what I would encourage you is, if you're spending money, you at least want to have a high level idea of where all the places that your money is going. Because in the times that things are tight, Maria and I already know if things really got tight on us. Let's just say, something happened to my career, or something happened and Maria wasn't bringing in as much. Gold's Gym, that membership can go. We have an Amazon Prime and a Netflix account. All right, Netflix can go because Amazon has their Prime stuff. We love our dog Coco, but Coco does cost money. Okay, if we had to come to parts with that, we would transition Coco up to my parents' house, probably, or Maria's parents' house. So there are things in our bill. We could cut our phone bill in half. There are things in our accounting system that we can cut in half. This is why this is a really great tool for your tracker. And I would say that this is an evaluation tool. There's a couple other things that you can do with this after you've done this work. So I've walked through it kind of generally. If you forget all of the moving parts and, oh my gosh, how do I put my spreadsheet together? Just remember this very, very simply. It's income, whatever you have coming in your house, divide that by 12 and use your after taxes minus your expenses that you pay on a monthly basis. That gives you your discretionary income. And again, what I talked about is you can add in your savings or your entertainment in there if you want to, or you can have it subcategorized and broken out, so that way you see how you spend your discretionary. But I would encourage you to have it all there. So there's a couple things. One, the rolling 3 years. Why the rolling 3 years? Because it allows you to plan and project. All right, because in 2015, Maria and I are looking at cutting a significant amount of our credit card debt down. All right. So that means my 2016 is going to look different, okay? And her YouTube business and her other endeavors, we project those to grow. So what I usually do is have whatever that tab, that section in my tracker is, I have 3 different versions of it. So I have my base version for any set year that I'm in. We're in 2015 right now. I can adjust and look out. And then I have a conservative look for the next 2 years. And then I have an aggressive look. So I have 3. 1, 2, 3. Base year, a conservative forecast for the next year. So conservative forecast would mean is we say we're going to pay off half of our consumer debt, but we only pay off a fourth of it. Or Maria's business doesn't grow as fast, or I don't get something at my job, or bonus isn't as large. An aggressive year is theoretically what's really, really attainable. Maria's subscribers grow by 2x. Yay! I get a promotion, or something else happens, we get a windfall that could theoretically happen. What that allows for you to do is have a range of expectations. So that way, if you're talking about taking a vacation, or we're talking about a 5-year anniversary trip for us, what really, really is realistic? Is it realistic to think that we can save $7,500 or save XYZ amount for a down payment on a car or for a vacation? And in that way, I kind of understand what levers need to be pulled, what we need to say yes to, what we need to say no to. There's always stuff that comes up. There's always stuff that comes up. And if you live in the moment, if you say, can I afford to buy this? Can I afford to do this? Can I afford to go there? A lot of times the situation may be, yeah, I can't afford to do it. But if you stack all of those yeses up, it may prevent you from something later on down the road. Guys, you gotta have a big picture about where you're going, okay? Let's see here. So I talked about adjusting bills as they change, okay? So hopefully as you pay your debt down, you can either learn to use that smarter, or you don't have to use it at all. So it opens up your ability to deleverage yourself, okay? If you know that you need a car in a couple years, if you know that you're trying to buy a house, that's where those bonus situations and taxes kind of fall into. So let's say, like us, you know that, wow, it's a great housing market, I want to buy a house. So here's some of the variables that you would change if you were trying to buy a house in 2017, all right? So you know that you're making $50,000 a year, you expect to get a 3% increase, so that's taking you up to $51,500 a year in 2016. You get a promotion in 2017, okay? And you're gonna be making $56,000 or $57,000, all right? So that means your bonus is gonna go up a little bit, and let's say you guys are gonna get $2,000 roughly each year back in taxes, okay? So you've got a little bit more income, all right, per month. You got some tax money, and you got some bonus money as well. But you know that you need to make a down payment for your home in 2017, all right? So you need to be thinking about, how much house do I need? This is when your little 3 things come in together. On a conservative standpoint, you may say, all right, I'm trying to get into a $150,000 house. Aggressively, you may say, I want to get into a $175,000 house, all right? minimum to get in the house is roughly somewhere between 3.5, all the way up to 6 or 5%, depending on if you go FHA versus conventional. Okay, that will help you understand: is it really realistic for you to get in a house in a couple of years? Okay, you may say, I need to knock a little bit of debt down. That makes my debt to income ratio look good. So I could talk forever about how we use this tool, all right, to figure out what we needed to get into our home. But as you guys can see, when you have 3 years together and you can understand your income, that gives you a chance to really look and plan for a big expense or a big picture. Drop a baby in there. If you guys are trying to have a baby, drop that in there as well. That's another example. So kind of done with that tab. All right, guys, we're going to move to another one. And it again is kind of based off of the previous two tabs. Debt reduction plan. All right, you need to have a plan tool for those of you that have a debt load, whether you have a student loan debt or a car or a house or credit card. Okay, you need to have a debt reduction tool. All right, so when you look at that debt reduction tool, it really draws from the information that you have from the second tab, which lists all of your accounts that you have, your loans and your creditors. So what does it look like to pay off your highest interest rate, your largest credit card bill? And then what do you do from there? Okay, what you can do, and this takes a little bit of work, a little bit of creativity on your side on how you want to portray this, but I looked at 3 years, again, another rolling 3 years, that what happens if I took my surplus money that I had on average per month and rolled that aggressively into debt reduction. So let's say I have $500 per month that I have something to do with. I'm being a little bit conservative here, so I'm not going to use it all for debt reduction, but I'll use half of it. Okay, so if I paid an additional $250 to my Capital One card that has a $3,000 balance, my minimum payment is $75. So I'm going to put 250 plus 75, what's that, 325, okay, toward my Capital One bill. How quickly can I knock that down? And sometimes you can use online tools to kind of calculate that. And then once you knock that down, you can put on your tool. That money will then be rolled into, so 325 plus whatever the balance is, the minimum balance is, and your next largest card rolls into that card. And you can see that your debt begins to chip away. So for us, we're taking care of all of our revolving credit over the next 18 months, and then we'll start working on student loans and then our car. And then in the next few years, pretty much the only thing that we'll probably have is the house and probably some student loans to deal with as well, okay? Then the last thing is what I call the Can I Afford tool. And this is a 5th tab, okay? And basically what this allows you to do is project on the fly. Like if you, right now, can I afford to go to California? Or can I afford to buy a camera? Can I afford to buy, probably shouldn't be big stuff, guys, but right now, can I afford to put new tires on my car? Okay, so what you'll need to do on this is kind of create a tool that allows you to manipulate, allows you to forecast for like a few weeks. So if you think about somewhere between 4 and 6 weeks, list out just in chronological order your dates. So let's say today is, April 1st, and I get paid on April 1st, and I get paid on April 15th, okay? So whatever your previous balance is, or your balance in your account right now, let's say it's $2,000, and you're gonna get paid another $1,000 on the 1st and another $1,000 on the 15th, okay? So what you'll do is you'll create this rolling tab, and you'll have all of your bills listed as well by the month, okay? So if you drop in and say, I need to know, can I afford to go to Chicago? Can I afford to fly up there? Or can I afford to put tires on my car? Which is basically saying I've got a big expense that's not really accounted for in my budget. It's kind of a one-time thing. Can I afford to do it? What you need to be able to do is look and say, can I afford it? Or how am I going to get by? That's another way to look at it as well if you're kind of in a pinch, all right? And basically what this allows you to do is understand if you make a choice on April 14th, what impact does it have when you roll into the next month? If you make a choice to buy, a $500 set of tires versus a $300 set of tires, what effect does that have when you roll over into May? Are you going to be able to pay your rent? Are you going to be able to pay your bills? Are you going to have a disruption in time? Again, This probably isn't for folks that have $10,000 in their savings account or whatever amount of money that you're living kind of comfortably. This is Maria not being transparent. This is just to say, for folks that are struggling at times, you need to know, cannot afford to be able to spend this money without a disruption. And the last thing, guys, is the last tab is hopefully as you're building assets, okay, and you're building wealth, your 401k, your retirement, make sure you have a tab for that as well. That is very, very important. A lot of times we focus on trying to make it and trying to get this and trying to reduce debt. We want you guys to build assets too. Know your car value, your Kelley Blue Book value of your cars. Know your home value, okay, which is basically how much your house is worth roughly minus how much you have left to pay on it. Your loan to value ratio basically. If you have other valuables and things like jewelry in your house as well, you can list that too, but I'm really talking about financial instruments, 401k, stock options, mutual funds, portfolio. Capture all that as well and make sure you update that probably on a quarterly basis. Because you can take all of these tabs, and if you wanted to, create a 7th tab, which I don't have on my notes done, and give yourself a rough approximation of what your net worth is. Okay, and your net worth is everything in tab 6, which is your assets, minus all of your debts that you have, so your credit cards and your loans, and that gives you your net worth. That's a really, really rough way to kind of look at it. Now, it doesn't take into factor how much your camera is and your jewels, and if you had to liquidate everything in your house, but it'll give you a good feel if you're going to get a loan or small business starting of what your net worth is. So I gave you guys a lot. It's kind of a long video. I'll look at it with Maria. May have to do some video, may have to do some other stuff for this, but hopefully it's helpful. And again, this isn't to teach you or to show you how to fish or to give you a fish. This is really to teach you how to fish and how to think. Because the most important thing you can get from this session or from this time is how to think about your finances. Think about it on a daily basis, not saying that you should, but as you're planning and you're trying to take care of your family, regardless of what your structure is, looking forward into the future, is very, very important. So enjoy the here and the now, look and plan for in the future. And if you guys have any questions, comments, thoughts, let us know in the comment box below. Make sure you please subscribe, and thank you. Hey guys, thanks for watching. We really enjoy having you as part of our viewing community. Please make sure you subscribe. We do post new vlogs weekly, and check out our older vlogs as well. There's a lot of great content there. And while you're at it, also look at our small talk playlist. There's just a lot of great information about family, finances, marriage, just general stuff that we go through, and I think you do too. Again, subscribe. It's our way of knowing that you like what we're putting out. We really enjoy this, and we hope you do too.